Welcome to the Delaware Mortgage Rate Weekly Mortgage Market Update for the week of January 13th, 2014. Hello, I'm John Thomas with Primary Residential Mortgage, here to give you your update. Well, last week's we did see Delaware mortgage rates finally move lower after a big run higher. On Friday, there was a very unexpected December jobs report. Came out worse than we were expecting. That did move interest rates. If you look at the bond chart on the screen, you can see the big green candle on Friday. That was where the bond market rallied after a bad December jobs report came out. 74,000 jobs created versus 197,000 expected. So during the week, we've been moving down in anticipation of a better job market, and then the report comes out Friday. Bond market rallies all day, ends higher, but we did stop at a point there for some resistance. The 50-day moving average, the 100-day moving average was capping bond prices. So we are going to recommend floating your Delaware mortgage rate to start the week, but you got to be mindful. The pricing was capped on Friday by the 50-day and the 100-day moving average and a line of resistance. So that's going to be a tough point to break through. If the bond gets turned lower again, we would quickly switch to a locking stance, take advantage of these gains and the rates ticking down slightly. Because the long-term trend is still for mortgage rates to move higher as 2014 moves on. We talked about the last update, the reasons for that. So the long-term trend is still for rates to move higher. So definitely makes sense to get out there, get under contract, and lock in your rate. But you can start the week floating. Now let's dig into that jobs report that came out on Friday, December 2013 jobs report released by the U.S. Labor Department. Again, released only 74,000 jobs created for December, expecting 197,000. Big miss, big disappointment. We thought the economy was definitely on track, creating more jobs. We had a great jobs report in November. We're expecting to build on that. Just didn't happen. Now, surprisingly, jobs was down, but the unemployment rate dropped from 7% to 6.7%. That doesn't quite make sense. But if you dig into how that number is calculated, it certainly makes sense. The unemployment number ticked down not because people went back to work, as you can see from the jobs report, but because 346,000 people left the workforce, so they're no longer counted in that calculation, so that's why it's dropped. The better indication on the labor force and what's going on is the labor force participation rate, the LFPR, and that dropped back down to 62.8%. That's the lowest since 1978. So that is in line with the jobs report. Less jobs created, less people working. So that gives us a real read on what's going on in the economy. So again, to keep a turnaround going in the economy, we need jobs to be created. So we'll have to see what happens in January. And then on Thursday, we had the weekly initial jobs report come out. It did drop 15,000 to 330,000 claims. We were expecting 338,000, but that number is not going to affect the market at all because of that bad jobs report on Friday. And we need the weekly initial jobless claims to drop below 300,000 to keep the labor market back on track. So we've been having higher weekly initial jobless claims. That's what was reflected in the December jobs report of only 74,000 jobs. Now, some big mortgage rules took effect on Friday, January 10th. Two big rules: qualified mortgage took effect, QM, and the ability to repay, ATR. Most of the stuff will not have a big effect on you getting a mortgage, but there are some little things in the law that can affect you and affect you negatively. So the qualified mortgage, the ability to repay, in there is a cap of 3% on points and fees on any mortgage loan. Now, how that's going to affect the borrowers two ways. If you're getting a conventional loan and you wanted to buy out your mortgage insurance, it's called borrower paid upfront mortgage insurance. That fee is calculated in the points and fee cap. So if you're trying to put down only 5%, you may not be able to buy out the mortgage insurance because the price of that plus the other normal fees on a loan would kick you above the 3%. So the rule may make borrowers have to put 10% down to buy out their mortgage insurance. It's going to depend on your credit score and the mortgage insurance carrier, but that is a negative impact of the law. The other impact on the law is it's going to probably affect your ability to buy down the rate called discount points, because those are counted into the 3% cap sometimes and sometimes they're not. It's a weird calculation, so that may affect how many points you could buy a loan down. So again, two unintended consequences from the law, but for the most part will not affect you getting a mortgage, but it could affect or delay closings because some of the other stuff that comes in effect with the law, like there's some appraisal stuff that's coming out that's new as well. So we'll do some more updates on that for you, give you more clarification. But for the most part, business as usual, unless you're doing borrower up front paid mortgage insurance or trying to pay down discount points. Now, in the local news, the next free first-time homebuyer seminar is this Saturday, January 18th. That's in Newark, Delaware at the Christiana Hilton Hotel from 10 a.m. to noon. You can register for that event by giving us a call 302-703-0727 or online, www.delawarehomebuyerseminars.com. And then in February, starting off February 8th in Dover, Delaware at the Holiday Inn. You can register for that event as well on the website. So look forward to seeing you guys next week.